started. Got a fair bit to cover today. We're going to talk about volatility forecasting, talk about correlation forecasting, and we're also going to talk about skewness. The first part we'll be talking exclusively about volatility. You actually have to do some volatility modeling, very simple volatility modeling, in your assignment number 3. The last part is a simple, what will be known as kind of an arch one kind of model. And we're very pleased today to have a special guest, Campbell, who I'm going to interview about GARCH. So that's going to be a little interesting. But to start things off, we need some basics. And what I would like to do, and Tim, why don't you come on up here? I'm going to go to the overhead and explain the basic intuition as to where we're actually going today. And then we're just going to sit down and talk about volatility modeling in general. So the first thing, what we've already established is the expected return mechanism. And that's mainly what you're working at in assignment number 3, is expected returns. So we have some sort of model of expected returns. We're forecasting returns, I'll call that R sub t. Okay, and they're going to be a function of some b0, that's a parameter, plus b1, and let's call it z t minus 1. Some variable, like the term structure that we're using to forecast the returns. So notice the timing here, t minus 1 and t. We're using t minus 1 to forecast stuff at time t. Okay, and that's what you're mainly doing in assignment number 3. And we could also write this in terms of RT equals b0 plus b1 z t minus 1 plus some error, residual. Okay, it's the same thing, right? And of course, our expected value of the residual is 0. Okay. What we're going to do is to operate on this residual a little bit. Okay, so think of running a regression for assignment number 3 and collecting the residuals. We're going to file those residuals away. Because the next thing we're interested in is the volatility. So the volatility of the asset class R. And that might be, let's say, world equity returns. Now, let me just introduce a little bit of notation here. Hopefully it's a simple notation. When I do expectation of RT, I'll sometimes put a line down here and say it's conditional on z t minus 1. So conditional upon the lag value of the term structure spread, I've got a forecast of RT. So give me the term structure spread at the end of January 2001, and I'll feed it through this model, multiply by B1, and then add the intercept B0, and I'll get a conditionally expected return or forecasted return for February 2001. So there's just notation here. So what we want to do next is the volatility. Okay, and I think you know what the general definition of volatility is. I'll just repeat that. The general definition is RT minus the mean of RT, and let's just call that expected RT, and then we're actually going to square that. Okay? That's just variance. Okay? It's just the variance. You push the variance button, that's what you get. So you can think of doing this in Excel. You've got your returns in one column, and then you've got a mean, the same value in every single row of those returns. Subtract the two, put it in a third column, square it, okay, and then take the average. And that's the variance. Okay, there's a reason I'm going through the details, because what we really want is the conditional variance. So when we're using conditioning information, we're not going to use the overall average of RT here. So what we actually want to do is to take RT, which is in one column, subtract off the expectation of RT, okay? And then we're going to square that. And what is this thing here? The actual value of RT minus the conditional expectation of RT. In the context of our regression model, the residual. That's all it is. What's not expected. The actual minus what's expected is the residual. So we could write this as the epsilon squared. And then what we want to do is to get the expectation of that conditional on information at t minus 1. Okay? And this is a very simple way to model volatility. So let me go through the steps. We've got some regression model for your returns. You pick off the residuals. You square those residuals, and you try to forecast those residuals. In the simplest model, and the one that I have you actually do in assignment number 3, is simply to take the squared residuals and let them be a function of the lag squared residuals in some sort of model. And it's called an arch model. Arch 1. A very simple model. And you're going to find it's actually a very unreliable model too. It's going to be very difficult to actually run this regression. It's going to have very low explanatory power. Okay, so just let me go through the steps again. Run your regression, pick off the residuals, square the residuals, and then try to forecast them. Okay? Now, Tim comes in with a major innovation in volatility modeling. 1986, published a paper in Journal of Econometrics called Generalized Autoregressive Conditional Heteroscedasticity, or GARCH. And he's got a different formulation of this model. It looks similar, but let me write it down. We're going to basically create a volatility series. And that volatility series, let's call it VT, is going to be a function, we'll use different parameters here, D0 plus D1, VT minus 1, plus D2, our residual squared. Okay, and this VT is not really observable. We're creating a volatility. And usually, and I'm going to have him kind of take you through the algorithm to actually do this. This is actually not something you can press a button in stack graphics for. It's actually an iterative process to get the estimates of these parameters. We've got this thing, right? We've got that. That comes out of our model for the mean. But we don't really have this. So what we do is to start this off. So we start the algorithm with the very first observation of VT. And let's say we're starting in, February 1970. let that equal just the overall average variance over the whole time period. Okay? And then we'll just make some assumptions as to what D0, D1, and D2 are. Just put some numbers in. So we put in February 1970 average variance into here. We know what the February 1970 squared residual is. We're making an assumption on D1 and D2 and D0. And we generate the next observation. Okay, so this is, this is something that we don't estimate in Excel because it's going to be iterative to get these parameters. But Tim, why don't you maybe walk us through the basic idea here?
Yeah, let me see sort of I'm not exactly sure what your background is in terms of the statistics that is required in doing this. But as Cam was pointing out, the basic idea he put out very, very nicely is you start out, in a simple way, you can start out with these residuals that you get from your conditional mean expected returns, square them, and then you can recursively build up these volatility, these variance series. Okay? And the way you simply do that is give it an initial guess on these parameters. This works as a recursion. You start out with your very first residual, say on February 1970, a guess on what is the variance at that time, which inherently is this unobservable latent thing. We don't really observe the variance. We observe returns, but we don't observe variances or volatility per se. So we've got to come up with a guess on what that is. Given that guess, we can then, given that guess, our residual from the mean and our three parameters, we can build up and figure out from that equation what is the variance in March 1970. What is then sticking that in there, you build up, figure out what is the variance in April 1970, and so forth. Now that requires you to know what the actual parameters, Cam here called D sub 0, D1, D2 are. And we don't know those in general. We've got to have to estimate those somehow. I don't really, or maybe Cam will tell me otherwise to do that, I hadn't really planned in this particular class on going in and telling you in details how you would do the estimation of that. Doing that requires some somewhat complicated statistical procedures. Now it's not more complicated than that. I mean, these things can actually be estimated in a lot of canned packages out there. There are things like SAS, TSP, and other programs that I'm sure many of you have heard about that do estimation of exactly this type of model. So what you do is you give the data series, the epsilons in effect, and then the program will come up with the best guess, the best estimates of D0, D1, and D2, given this sort of complicated nonlinear structure. But the intuition is very much, as Cam explained to us, you simply just build up these unobservable variances from this recursion.
Okay, and I guess one thing that's a little hard to come to grips with initially is this idea that variance is not observed. Okay, Tim said that. We need to use some sort of plug number for that initially, start building up this recursion. But variance is not observed. And indeed, expected returns are not observed. We observe returns, see what's realized, and we try to model the expected returns. So your assignment number 3, you're trying to model the expected returns. So what I wrote up there, the expectation of RT conditional on ZT minus 1 is a model of expected returns. And we are not claiming that this is the true model of expected returns. Like, how can you assess whether it's a true model? If you really think about it, it's extremely difficult. You might say, well, I've looked at all these models of the mean return, and this model has got the highest R squared. So therefore, it's the best model. This must be the true expected return. Well, not necessarily the case, because you might have overfit the data. Or there might be some other model that you didn't discover that's got much higher explanatory power. So the R squared could be too high, or it could be too low. And we have no way of figuring out what the true model actually is.
So by the same token, if I just say here, I mean, that very much goes, of course, for the variance. This, in some sense, even more so. This is unobservable to begin with. This is really nothing but a purely sort of ad hoc statistical way of gradually, recursively coming up with estimates of what this unobservable thing is. Now you could do like what Cam did before in terms of estimating expected returns. You could think about putting in here, instead of these two terms that we have here, you could equally well put in things like d, c, t minus 1, where the ct minus 1, so forget about this, put in ct minus 1, where the ct minus 1 are some of these other explanatory variables, possibly some of the things that help explain the expected returns, might help explain this variance. That would be very good to do so. The problem is that there's been a lot of researchers, both in academia and practitioners, that have tried to come up with good explanatory variables for the variance. What are these CT variables? And you're generally very hard pressed to find things that work very well in terms of explaining the variance. And that's why this purely statistical updating scheme here has found such a wide use as it has, because it sort of conveniently bypasses this idea of making explicit assumptions about what are the variables that truly characterize the variance. Now, it would be ideal if we knew what those are, but we don't. So what we do instead is we say, look, we know that the variance is probably changing over time. And we know that for a lot of the reasons that I'm sure Cam have told you about in the first lectures in this class, we have to take that into consideration in our various asset allocation strategic decisions. And this provides us with a very convenient, flexible ways of doing so without having to take an explicit stand on what the CTs are.
Yeah, let's sit down and talk about this, because I got some questions for you.
Okay.
Okay, so it's difficult to forecast expected returns. You're finding this out, right? In your assignment number 3. Hopefully you've started, because it's more work than assignment number 2. Did I tell you that already? Probably not. So it's difficult to forecast the returns. Very difficult. But is it easier to forecast variance? That's the question. And kind of the way that, one way to think about this, there was one group in assignment number 2 that used so-called ARIMA style model for the returns. And that's just saying that the returns are a function of the lag returns. When you actually put the lag return, so you estimate an autoregressive model for returns, it's extremely unlikely for most stock markets that you're going to get any predictability whatsoever. And if you do get some predictability, it's probably just by chance or because of market imperfection. So to use an autoregressive model, which simply means you're using a lag value for the returns, is not going to get you anywhere. Okay, and what we want to use for our returns are these z variables that have some sort of economic foundation. Now we go to Tim, who's saying, well, for the variance, yeah, you can stick those z's in there, but they're not going to buy you that much. The autoregressive or statistical structure is probably like more reliable. So I guess the first thing, that seems to be a bit of a disconnect because for the returns we're using these z's, you get a lot of mileage just out of the autoregressive structure for volatility. And what's the intuition behind that?
Well, that's always true. As we were just talking about, you are hard-pressed to find C variables that work very well for variance. On the other hand, you're going to find that in terms of explaining variations in the variance, or variances over time, this statistical structure does very well. I think one important difference, I think that is sort of worthwhile keeping in mind when you think about estimating expected returns and variances, is that for estimating expected returns, in general, how frequently you observe your data whether you have monthly returns to go by and estimate by, or whether you might have daily returns, in general, it's not going to buy you a lot of explanatory power as far as being able to more precisely estimate the mean. This is not entirely true. In general, you do earn more power by going from monthly to daily, say, return observations. But the increment in terms of explanatory power is not great. That's very, very different when we talk about estimating volatility or variances. That if you go from a monthly observation frequency to, say, a daily frequency, as far as being able to estimate the variance, you get a lot more explanatory power. And
do you think that's due to just like for the equity returns, there's a lot of error in them?
No, I think it's a little bit more than that. If you just sort of think back sort of anecdotally, what happened in the market, say, last spring. There were a lot of days when, say, the Nasdaq was up 100 points, down 100 points within the same day. In terms of the variance, a day like that, where the price starts out the same and ends up the same, it's going to look like a very low variance day. But that's not true. If it goes up by 100, down by 100 within the same day, that's a lot of variability. Just using daily returns as a way of measuring that is going to miss that completely. Whereas if you had sort of, in this context now, higher frequency returns, say hourly returns, you would clearly pick up the fact that there was a lot of variability in that day. Well, that same thing sort of goes again if you sort of think about the same idea from comparing monthly to say daily. Maybe I can just sort of show you a little graph to illustrate that. That if, suppose that we have a price starting out here at time t, ending at time t plus 1, okay? Price would kind of wander like that. Start out with a price here, time t for this particular asset, and in another time, price t is a little t, and plus uppercase t. Okay. If you want to estimate the expected return on this price, okay, over this time period, basically what's going to matter is going to be something like the price at time little t plus cap t minus the price at time little t divided by how many time periods I'm looking at, cap t, and that's going to be my estimate sort of roughly of what is the average return sort of increments over this period. Okay? I could draw another graph, see if I can draw it here, that's going to look like this. And again, this would be time t plus 1. This price, supposedly, the idea being, the way I've drawn it, is that this mean, the increments from there to there, is kind of the same height as up here, so that the mean return is going to be the same. Okay? But it's clear that when you look at this, this is a lot more volatile price process. Okay? I will see that if I get to observe this more and more frequently. If I only had observations, say here, here, and here, say down here, here, and here, and here, and I calculate the variance on the basis of those 3 observations, I might conclude that these 2 are equally variable. But that obviously misses the boat completely. Whereas if I down here now start observing more and more frequently, I'm going to pick up on this fact that this is a very, very volatile price process. Whereas this is not. On the other hand, observing this price process more frequently down here, and observing this price process more frequently up there, is not going to alter my estimate of the average increment over each and every period. The mean return is going to be the same whether I observe just the end, the beginning and the end, sorry, or whether I observe all of these in between.
If you take a more frequent time estimate on the bottom of your volatility, won't that change what your t is in the denominator? And so, shouldn't that change your mean?
It will certainly change the way I'm going to do my sort of formal calculations, and I'm going to have to pay sort of respect to that how often do I observe my observation. I have to scale things accordingly. That if I measure the price increment not over cap t time periods, but only over, say, one of these smaller periods, I have to sort of scale over things up or down accordingly. Okay. But I hope sort of the intuition is clear that this observing this more frequently is going to allow me to say, look, gee, this is very volatile, whereas this one isn't. And by the same token, observing this more frequently is not going to alter the average increment. It's going to be the same.
Right. If you go from one price to the same price, the mean's going to be the same. It doesn't
Right.
matter.
Right.
You have to worry about how you compound, of course.
Right.
It's got to be logarithmic
Right. This,
returns,
of
so you
course,
just
is
add
very-
them all up.
yeah.
But it's going to be identical. But okay, I guess the thing that, like, I agree with that. But you know, so it seems like that volatility in the second graph is only relevant if I'm actually doing asset allocation within the day, like if this is a day. Okay, so you know, so talk to me about the horizon. Obviously, if we look at you know, even within a month, right? You can start the S&P at one value and end up at basically the same value, but there's been massive volatility within the month. But if I'm doing my asset allocation on a monthly basis, does it matter?
I think very much so. And I think very much so because there's also mounting evidence that these variances or volatilities change in this predictable fashion as we talked about, but they change in sort of a very, very slowly persistent fashion. So that volatility could be high for like years and then sort of go down. And it really does matter whether you use the right volatility assumptions in your asset allocation decisions.
Okay, well, what is right volatility assumption? That's
Okay.
what we're talking about.
Okay, that's correct, and that of course is the difficulty here because we never get to observe this animal really. These are unobservable things. So what we can do is we can try to sort of best benchmark models of the sort we talked about before and think about do they sort of on average equal the variance what they're going to do. And we can also ask sort of the more constructive question that if we start using those models, do we make better financial decisions doing that, as opposed to just treating the variance or the volatility as being constant over time?
Okay, I don't want to jump to constant over time because that's an extreme assumption.
Okay.
But what we're really talking about is like measuring the variance, let's say, on a monthly basis or on a daily basis. So we know that there could be a lot of stuff going on within the month that we ignore when doing monthly.
Right.
Okay? But if our asset allocation, if our portfolio decision is the last day of the month, we make our tactical decision. What I'm worried about is, yeah, there's a lot of intraday variability, and if I estimated using a Garch model on the daily returns, I might get a larger variance than the monthly, and that would tend to penalize certain asset classes. And the question, what should I use?
That is a concern. But by the same token, remember when we talked about this Garch model, we had two parameters in there. We had something called a D1 and a D2 parameter that reflected the sensitivity to return the sort of squared surprise in the return, the epsilon term, and the other term reflected sort of the average volatility. What you find most often if you estimate models of this sort, say on daily data, is that the term, I think we call it a D1 coefficient, that loads onto the volatility, this latent BT minus 1 term, that's a very big number, which in effect serves to sort of smooth out a lot of this sort of intraday or sort of day-to-day variation that appears in the second term, the D2 times epsilon T minus 1 term. So the model does that smoothing for you so that you're not going to be sort of prone to those concerns that Cam was alluding to, that you're going to have a big surprise today, if you're going to do your monthly decisions tomorrow, you're going to be sort of thrown totally off in terms of your volatility estimates. No, the model sort of keeps a balance and then say, look, okay, volatility might be high, and we're going to update it a little bit, but only a little bit because the D2 coefficient is going to be a sort of fairly small number, say 0.05, 0.1, whereas the D1 typically, in empirical estimation, is going to be a number around like 0.9.
Okay, so I think that's an important point. So because you've got the squared surprise, or our residual from our mean forecasting model, the Garch model is not that sensitive to like a surprise in the returns. Okay, that autoregressive structure makes the I say expected volatility, but volatility is expected by definition. It's a little confusing. It makes it somewhat smooth and persistent is the word that Tim is using here. So that that if it's high today, it's likely going to be high tomorrow. It's not flipping all over the place. Persistence means predictability, okay? But the thing that I'm trying to grapple with, and you come close to answering this question, but not exactly, that aside from a surprise in the returns, that if we estimate our GARCH model on daily data, there's a scenario that I'm going to get a higher variance than if I estimated my, let's say, GARCH model, and let's say both fit the data just fine, okay? Estimated my GARCH model on monthly data. And I'm making a monthly portfolio decision. And if I get a higher variance estimate for a particular asset class using daily data, then you know from your optimization exercise that it will likely decrease the weight in that particular asset class. And what I'm trying to figure out is, okay, we got an elegant model of variance. What do we do?
I'm still not sure I exactly sort of understand where you're going with this question.
Okay, let me rephrase it.
Help me out a little
Yeah,
bit.
let me rephrase it. We got, let's say, we estimate a GARCH model on monthly data. So we observe, just end of month returns, okay? And we get a forecasted variance that we're going to be using in our asset allocation. Okay. But this is a sort of series where there could be a lot of action within the month. Okay, just like you said, that if you observe the endpoints, it doesn't look like there's much going on, but within the month there can be wild gyrations. Okay, so given that we're estimating or we observe the data on monthly frequency, when we actually apply a GARCH style model to that monthly data, the volatility that we're going to get, that we're going to use in our asset allocation, could be much different than the volatility estimated on a daily basis.
Correct.
Okay,
Correct.
and the question is, what should I do? So should I use the one on the daily, which might fit the data a lot better, right? As you said, you get more power. Or should I use a monthly sort of estimator?
Well, it's a difficult question in general.
That's why I'm asking it.
I don't have the right answer. I mean, I think I would sort of resort to a little bit of what I said before, trying to get into it. We might not want to go there now. That is, instead of just judging the models in terms of these statistical fits and the sort of daily models that fit the data better in a statistical sense, you have to start thinking about and sort of do back testing and evaluation. If I really start and use these forecasts, do I make better financial decisions? And I think sort of some trial and error there is in order. I do think that on purely sort of statistical grounds, you are, everything else equal, better off using the model estimated on the daily data as opposed to the monthly one, because it would pick up the fact that there was a big increase all of a sudden in market volatility that the monthly model might miss. But you want to be a little bit careful that you don't sort of do too much of that, and you, of course, I'm sure you talked about transactions cost, rebalancing costs, and the like, and it's going to cost you doing that. So you want to be careful.
I guess like another way to view my point is we have to really struggle about like what is volatility, right? So
I mean, I think that's what it is. I mean, it's this unobservable thing that we never get to observe, and it's
okay. It's true, it's unobservable, but what is it? Like what are the fundamental like building blocks of volatility? So is the volatility that I want? I'm doing a 1 period ahead asset allocation, right? Using assignment number 3 in our optimizer that we built in assignment number 2. Okay, we're going to stick into it the conditionally expected returns, which you're building, and we're going to stick in the forecasted volatility for February 2001. Okay, and we're just going to be updating that model in a static way every single month. Okay, and kind of the fundamental question is, we got these 2 volatility models running. One fit on the monthly data, and one fit on daily data. The daily model looks a lot better. The parameters are tightly estimated. The monthly model, it's okay. It's acceptable, but we're used to kind of low explanatory power, whatever that is, in this model. And I guess what I'm struggling with is what is the right volatility to use, not what the right model is. We'll assume that the GARCH model is a good representation of the volatility process. to even refine this question a little more, the forecasted volatility that I'm going to get out of a monthly model is going to tell me something about a monthly horizon, which is my investment horizon. Whereas the forecast from a daily model at the end of January 2001, isn't it going to give me the volatility forecast for the first day of February?
I see where you're going, okay? And I think I didn't understand your question fully from before. True. You don't want to just forecast the volatility, say, as Cam was saying, for the January or sort of February 5th or 6th or whatever, and then scale that up sort of naive. Because that's not going to give you the right forecast for the months of February. You want to think about the forecast for the volatility for the months of February as being in effect the sum of, say, 20 daily forecasts. But one of these forecasts is going to be a forecast that's going to be just 1 day ahead. Another one is going to be a forecast that's going to be 2 days ahead. Another one is going to be 3 days ahead, and so forth. And the further you forecast into the future, the more uncertain your forecasts are going to be. And your forecasts are going to start looking more and more just like basically the average variance that is out there. That your forecast for the very longest horizons is going to converge to the average. So if you just did what Cam was suggesting, say take the 1 day ahead forecast and scale that up appropriately by multiplying it by say 20 or 22, how many days you might have, that's not going to be the right thing to do. And that is in fact going to be too volatile a forecast, because that's not going to capture that gradual, let's call it mean reversion, convergence to this average volatility. Okay? And that's important to keep that in mind, that if you build models for forecasting things, say 1 month ahead, you get a better model when you build it at the daily frequency, but then there is that extra complication that is not just a 1 step ahead forecast. It's going to be 22 forecasts. One is going to be 1 step ahead, another one's going to be 2 steps ahead, and so forth. We're going to have to combine those in the right fashion.
Okay, suppose you do that. Okay, so we're using our daily model, and it is like a really practical issue, right? We've got a couple of million to allocate, and we want to do the best possible job. And that's why most people are sitting here. So we've got the alternative of kind of correctly aggregating the daily model to get a monthly proxy for volatility, or using the monthly model to get a monthly proxy for volatility. In your research, do you get a sense of kind of the differences in fit between the two different models?
It goes back to some of the things we talked about before, and I guess it's still up there, this scribbles that I put up there, that by doing the model at the higher frequencies, say the daily, you're going to pick up these changes in the market environment in a much more sort of adapt fashion. You're going to be quicker to adapt to those changes than you would in the monthly model. So my research clearly suggests that you are better off by using the model at the highest frequency and then appropriately sort of combining your forecast if you say you want to disaggregate, so to speak, to get to a monthly forecast. Because you really do adapt in a much better way for the volatility. And that's a big difference for the returns, at least is what my research suggests. Again, in the returns, you do get better forecasts if you go to the daily as opposed to the monthly frequency. But the increments there, in terms of how much better, is really, in my opinion, fairly minor. And that's not the case with the volatility.
Sorry, I said a question. Does seasonality, can it play a role at all? Because if you're always looking at the most recent data to predict the next month or the following month, I mean, that might ignore the fact that in April it's always volatile, and in May it's never volatile, or as volatile, so that could really...
Definitely. No, that's a very good question. And people have started looking into that and found things of that sort, that there are certain seasonal patterns that you could, in effect, when people have done that, put on as extra C variables in the model structure we talked about before. In the GATS model structure we talked about before, we had this like D1 again times the volatility plus D2 times the squared return. So you could add on a D3 times CT, where CT would be some kind of dummy variable that is high, say, in the month of January. Okay? Or it is high around earnings announcements. Okay? Things of that sort generally do lead to higher volatility, and you're better off by incorporating that into your model.
Can you explain that again, how that would work? With I don't mean to get off the track, but in terms of like a dummy variable, in terms of incorporating that into the
Right.
equation.
So a simple way would be to have a variable. Say you're concerned about higher volatility around earnings announcements. Okay, and a quarterly schedule. Right? So you would have as an example. So you would have like a dummy variable. A variable CT would be equal to, if you're estimating the model using monthly data. The CT variable could be equal to 0, say January, February, and then it would be 1 in March, doesn't it? And then so forth. Okay? And then that would then serve to sort of pick up that heightened volatility that is associated with that.
So it just simply increases the level during those months where you know there's going to be announcements.
Right.
And I think that actually that's a very important direction for a lot of this research to go in terms of thinking about more structurally. Why is it we see this very pronounced volatility clustering? And come up with C variables like you're suggesting. That's going to help us in terms of doing that. Another one that helps tremendously is looking at things like trading volume. Okay, so that when there's a lot of trading going on, the volume is high, volatility is also high. And you could put that in there as one of your C variables, trading volume. And people have done that and found that it really seems to help a lot and improve on these models.
Question,
Well, we've
Chris?
still sort of dodged the question of what is volatility.
Well, it's variability, and that's sort of, it's the variance. Formally, it's the variance, as Campbell was defined, as this expected value of the difference between the actual return and what your expected return to be. Is that difference?
The square.
The square, the square of that difference. And
So-
that, you never get to observe that, because you never get to observe expectations, really.
But your other point, though, is that moving the window down, moving your time periods down to the day, why not even take it farther, like the 15-minute blocks to the trade?
That's a great idea. it's
I mean, it's
You
a pain in the
have
ass,
to do
but
that, it's recent research.
It's an idea that I, and along with other people, have been working a lot on over the past few years. This is something we only really have been able to do fairly recently because these tick-by-tick or trade-by-trade data are sort of a relatively new phenomenon. Okay, but that I think is very much where a lot of this is going to be going. And I know for a fact that there are investment houses that are pursuing that actively too. And I think there's a lot of promise in that. So that's a very good question. I think it's.
Yes.
How do you account for shocks like LTCM or whatever when you know
Right.
something jumps out? Do you just get rid of it and go back one more period or what?
Well, that's a very good question, and that, I mean, you have to be, like any statistical model, you have to use this along with some kind of sound judgment. And you have to be careful, because an event like that is going to show up like a gigantic epsilon term, potential. And it's going to throw off your recursive operating scheme completely. So you could, in principle, think about putting some kind of barriers in there. People have done that, so that if the epsilon really is like, it's too much out of whack, kind of discount it somehow. Or you don't necessarily just want to enter it in terms of its square. You could enter it in terms of its, say, its absolute value, which would be a little bit less prone to sort of really, really big outliers. Or you could find other ways of sort of down-weighting really big events. And again, experimentation, sort of playing around with this is kind of, I think, the best answer to concerns of that. But this is a model for market risk. It's not a model for like credit risk. It's market risk we're talking about.
Going back to what you were saying about calculating the monthly volatility, say taking the 1-day forecast and the 2-day forecast.
Right.
So you forecast each one separately. So you have a forecast for the 1-day, the 2-day, the 20, and then you combine them. How do you
Yes.
combine them then?
Okay. The simplest and sort of very good practical way of doing that is simply just to sum them up. Okay. That is not entirely correct. The returns are somehow correlated. Okay. So if there's a lot of predictability, if the mean returns you can pin that down very accurately, is another way of saying that. And simply adding them up is not always going to be the right way of doing it. But for practical purposes, that's a very good rule of thumb. So you just simply forecast 1 day ahead, 2 days ahead, 3 days ahead, and so forth, and you just sum them up. They'll work for the variance. Okay?
Wouldn't that give too much weight to the first days of the month?
No, that actually formally is the right way of doing this. It turns out. If you think about the returns, well, it depends on whether you use continuously compounded returns. I don't know if Campbell talked about in this class, but I'm sure you've heard about that in other classes. the continuously compounded returns, the monthly return is simply just the sum of the, say, daily returns within the months.
But you're talking about adding up squares.
Right.
Okay, and you're saying the only way you can add up the squares is if there's no covariance. Okay, so it's okay with the returns just to add them up, but you have to make some extra assumptions to get your question over here.
How predictive is this model really? I mean, are people out there making money by using this model and comparing against implied volatilities on index options and actually able to make money by trading when there's a discrepancy?
Good question. That's a very good question. I'm sure looking to ask some of our webcasters around there. I know for a fact that some of them are using this model, this very model. And there has been comparisons done along the lines that you're suggesting, comparing these to things like implied volatilities from options, and see whether these things improve upon that. And my reading of that literature is yes, that it clearly does.
So, from my experience, in any serious asset allocation process, in the firms that I've dealt with as an insider and as just a consultant coming from the outside, almost all of them have some sort of in-house process that evaluates volatility forecasting, and at least one of the models that's being used is a Garch-like model.
There's a very famous product out there that J.P. Morgan put out some years ago called Risk Metrics, that some of you might have heard about, which is in effect nothing but a Garch model. Okay? They run this Garch model every day and make forecasts of the Garch volatilities available actually on the internet for, I forget how many different assets and asset classes now, but it's a bunch. And that is in essence a Garch model.
It's a restricted Garch
Right.
model. Yeah. So they put some special restrictions.
Tim, you just said if one wants to derive the monthly, 1 year volatility from the daily data, then best estimate would be just to sum up all these numbers. But how consistent is that with the fact that on average the longer term volatility numbers are basically lower than the short term? When you reduce the window, then volatility goes up,
Well,
vice versa.
That's similar to my question in a way. You're just taking it over a longer horizon. So what is the right
It
thing to
could
do?
be that if you look today, it could be that the volatility today is very high relative to the average. But it could also be in a scenario, if I understand your question correctly, where the volatility today is low relative to the long run average. Like 2 years ago, the volatility in the S&P and sort of general markets was fairly low by sort of historical standard. That's no longer the case. And things sort of move around the average. Okay, so depending on where you start out, if you start out at currently a low volatility scenario and you're going to forecast long run, you're going to eventually sort of converge to the average. You can start out here and you're going to converge towards the average. But you could start out here, and that depends.
Yeah,
That might not be your question. I might have missed your question.
I just don't see how it converges. I mean, if we just multiply, if we look at 1 month horizon, then we should multiply the daily volatility by 30 or 20.
That's a function of the recursive structure in the model. There are certain actually restrictions on the parameters. You remember the model again we had before, like D1, D2 coefficients. You can show formally that as long as the sum of the D1 and the D2 coefficients are less than 1, and then you're going to get that convergence come into play.
The key thing is we're not taking the 1 day ahead forecast and then multiplying that by 250. That as we go for a longer horizon forecast, that forecast approaches the mean level of volatility. So it gets smoother when you go to a longer horizon.
And all I'm saying that as you become more and more uncertain, the longer you forecast into the future. And for a longer forecast, the best forecast is kind of the average, because that's where you are on average. So that if you're forecasting short term, there's a lot of information short term about where you are, and you're going to use that. For long term forecast, you're going to sort of say, well, probably going to be average, because that's really what you do.
For the very long term. Yeah, and I guess, how does, we've talked briefly about this idea of kind of time diversification. I guess this works into, I'm not sure how that relates to mean reversion. So I guess, the point here is that over the long horizon, you would think that volatility is lower. So if we sample the S&P 500 and look at 10-year returns and just look at those blocks through time, overlapping, let's say, we're going to be hard pressed to find any block where there's a negative return. Like there's like 1929 to 1938, and it's a very small negative return. So if we sample by 10 years, it seems like volatility fundamentally is much lower than if we're sampling like on an intraday basis.
That is correct, and that is related to, you might have talked about that in your previous class, these long-run mean reversions.
Yes.
And that's going to manifest itself in exactly the way that Cam is talking about now. That if you have these so-called mean reversions, prices, then over a very long horizon, the volatility, appropriately scaled, is going to be smaller than over shorter horizons, or scale up to match that same horizon. That comes through simply due to this mean reversion. Prices are converging towards some kind of mean.
Okay, I get a question, an empirical question. It seems like that's really important for what we're doing in terms of we need to know our horizon for asset allocation. We need to know whether we should be using daily Garch model for the monthly or quarterly or annual. Should we be aggregating that? Now, you said that the D1 and the D2 coefficient, together kind of imply how we kind of mean revert. Okay, and the empirical question is, are we going to see different speeds of mean reversion implied by a Garch model estimated over a daily horizon or one estimated over a monthly horizon? And adjusting for the fact that the daily has got 250 periods that you're going to be forecasting, and the monthly, let's say 12 if we're looking at a year. So is there any inconsistency there?
In my research, I haven't been able to sort of find any inconsistencies along those lines. But that is certainly a good question. Part of the problem in terms of really getting to the bottom of that is that these models, as far as estimation are concerned, are somewhat data intensive, and it's difficult to estimate models of this sort over sort of very, very long horizons. So if you're going to go out and you're going to estimate this model, say, over 5-year horizons, you're not going to have that many 5-year horizons, really. And that makes estimation of these models somewhat sort of iffy.
What about using overlapping data?
You can do that. That makes it a whole lot more complicated dealing with that. And that's a good suggestion. It's a good idea. It's something that I don't think can really be sort of fully worked out.
There are some other questions. Yes, Brian.
Speaking of the overlapping issue, so does that mean that when we use the Garch model here, that we should use discrete chunks that don't overlap if, say, for example, we decide to use
That's effectively what we're going to be doing.
I would say, doing otherwise can certainly make things, as what Ken was suggesting, much more efficient in principle, but it's also a heck of a lot more complicated than doing statistics right there.
I want to return to a question that we didn't fully answer, and that was about the implied volatility. So we answered the question that it is true the Garch kind of technique is used in asset allocation. You need to know the basics of Garch, and that's kind of what we're doing today. But we can think about actually using it in some sort of asset allocation strategy and kind of comparing the performance of our tactical strategy using Garch to the performance of some other volatility forecasting method. And we can actually look at returns. We have we could do a real test, let's say over 10 years. Use the forecast of the Garch volatilities, and indeed when you estimate this with many different assets, we also get forecasted covariances, which is very convenient. So we've got basically everything we need. We've got the means, covariances, and variances. And we can actually look at the performance of a strategy like that compared to an alternative model. And indeed, people have done that, and that's one of the reasons that people use some sort of Garch framework for asset allocation, because getting that volatility correct is important. I said, I think, last lecture, that getting the expected returns right is more important than the volatility. Nevertheless, we have to do our best possible job on all of these moments. But one question is, what about options? Because with options, we talk all the time about the implied volatility. And if you're thinking about kind of a forward-looking volatility that we can observe for asset allocation, And if we're thinking of allocating across, equity indices for, G7 countries, well, we can observe an implied volatility in the options market. So that seems to be a highly nonlinear model that's capturing a huge amount of information and collapsing that information on an option price. We can look at the money, around the money, average the puts and the calls, and we've got an implied volatility that's forward-looking for perhaps multiple horizons, and we don't have to invest in your machinery.
Okay, a couple of things. First off, this requires you for there to be an actively sort of traded options market, which there are for many
For
banks.
G7,
fine.
there is, yeah.
Okay. It's not easy to get implied covariances out of option prices. Okay, and that, as I'm sure Campbell told you, is a very key important ingredient. In fact, there are many more covariances really in there, so as allocation decisions, than there are variances. And that's just not a thing that comes natural out in terms of implied covariance from an option price. Another thing along those lines is that even though we have these implied option volatilities, that when you sort of start thinking about it, they're really internally inconsistent. Like when we talk about implied volatilities, they're based on the Black-Scholes option pricing formula. If you remember back to when you talked about, I'm not sure everyone in there have talked about the Black-Scholes option pricing formula, but for those of you that have, there was an assumption in there in the way that formula was derived. That assumption was that the volatility was constant over the maturity time of the option. Well, the whole point here is that the volatility is changing through time. So there's a logical inconsistency here in terms of using these implied volatilities from a model that assumes them to be constant and then treating them as time variant. That's not to say that it can't be done, and people aren't doing it, but it obviously isn't entirely sort of tight in all dimensions.
Okay, so just let me interrupt here. So everybody sees that. The Black-Scholes, which you all done in your course, Intro Finance, assumes a constant volatility. Yet, if you look at the implied volatility, it's flipping all over the place. So what kind of model is that? So, well, it's a model that actually is an approximation. That's the answer to the question. And indeed, there are option pricing models out there that include what's known as stochastic volatility. So you let the volatility change through time. So we do have theories like that you probably haven't done unless you've done an advanced derivatives course. So there's an alternative framework to the Black-Scholes, say a stochastic volatility type of framework.
That takes seriously the fact that we talked about today,
right,
that the volatility is time variant.
Okay, now what happens? I've got this model that's much more difficult to estimate, the stochastic volatility model, right? And I put it side by side with the Black-Scholes model with particular options. The options that are at the money and that have relatively short time expiration. Okay, let's say a month, 2 months, 3 months. What you get out of the stochastic volatility model and the Black-Scholes is about the same. So I guess I return to my question, why not use Black-Scholes or some modification instead of the Garch?
The covariances.
The covariances.
I think the covariances are very key to this.
Okay, so if you had a choice, right, you're actually doing the allocation, what about the scenario where you run the Garch model, get the covariances, and then use the implied vols for your volatility part? Or would you prefer just using the whole Garch framework?
No, I wouldn't. I mean, I certainly am all for using all the information that we have out there, and it's clear that there's a lot of market information that potentially is very useful in the implied volatilities. Because implicitly, implied volatilities have the C variables in there that we're kind of searching for. These other things that really intrinsically is what affects the volatility, that the Garch model is just sort of adaptively trying to pick up on. The implied volatilities, by the way the market prices the options, have that in there if the market is efficient, to some degree that is.
What about, remember you wrote up on a previous slide, put in some other information into the Garch model, and you said something like, well, that stuff is really hard to specify, doesn't come in. Why not dump the implied volatility directly into the Garch head?
Good idea, and you could certainly do that, and sort of get the best of both worlds, so to speak, and people are doing that. And that's
So that's
Right.
actually a feasible thing to do. Yeah, and then, of course, it begs the question as to what implied volatility really
It's
means.
really, yeah,
What,
yeah.
no, but fundamentally, what is it measuring? Is it measuring a daily kind of volatility? Is it measuring an intraday volatility? Is it measuring a volatility over the expiration of the option? You know, again, it's this idea of like what is volatility? It's this unobserved expectation of variability. Louisa, you have a question?
I was wondering, the implied volatility, will it be an unconditional or a conditional rate?
It's conditional because it's conditional upon what's happening in the market. So I think it qualifies for what we're looking for. You know, people are setting this volatility. It's their expectation of the variability of the underlying asset, right? That's exactly what we want for asset allocation. The Garch model delivers a different way to get that expectation of variability. And I guess where I'm kind of pushing stuff towards is, you know, using the information in both the Garch and in any other method that we could grab to get a better estimate of volatility. Again, you know, what does better mean?
Right.
You know, we're faced with this dilemma that we can't benchmark against the expectation because we don't have the expectation. So with it's the same thing with the expected return, right? We don't benchmark against some other expected return. We just benchmark against the actual return. So how well does our forecasted return track the actual return? That's what we do. We don't ask the question, how well does our forecasted return track the true forecasted return?
Well, the returns, though, it's a little bit easier because we do get to observe ex post the actual returns, what they turn out to be, and we can then compare what our forecasting model told us that those were. And we can look at, in effect, the epsilons, the residuals, and see, do they really look like there's something in there that we could have predicted that our model failed to pick up on? Or are they truly unpredictable, which they should be if our model is a good model? For the variance, again, remember, we never get to observe this thing. So we can't really inherently sort of benchmark it against something we observe. So that's
you do observe the ex post variance.
We observe the sort of the squared epsilon, but then there's sort of also the squared expected returns in there, and it's
you never observe it in the bottom line. Okay, any other questions for Tim? Yes.
I'm not sure. How do you get covariance from the action?
okay. We didn't really talk about that, and so that's a good question.
Actually, we're going to be talking about the covariance after the break, and I'm going to show you how to get the covariance from a Garch model or any other model. And basically, what we're going to do is we're going to take those epsilons, right? I have just one epsilon, the residual for asset one, and then we're going to multiply that by the epsilon for asset class number 2. And we're going to try to forecast that, and that's going to be the covariance, because that's kind of like where we're going. So we can, and indeed with the Garch model, it's very elegant that we can do this all in one sort of estimation, whereas other models have to go kind of piecewise. Okay, so this, Garch is, I don't want to overstate this, but the amount that is used easily dominates the amount that the CAPM is used in finance. Okay, so this is really important stuff. You cannot leave an asset allocation course without knowing the basics of volatility modeling. And and I think we're pretty close to there. This is really one of these foundational sort of achievements in finance and economics. And I say finance, but we use it in economics all the time also. Indeed, some of the first applications of Garch are today, I guess, Rob's paper on inflation modeling in the UK. So we use this technique in many different applications, and there's a lot of stuff, I think, personally, that we've got kind of the benchmark model, which is statistical, in that we're using an autoregressive kind of structure. And what most excites me about the future of volatility modeling is to bring in things like other information into the actual forecasting, like looking at the option market and other things that might be important. So a lot of models And there's how many variants of Garch? About
I don't even, I lost, because
it's like hundreds of different variants of Garch with different names like eGarch and PhiGarch, where they just changed the model a little bit. But one model that I think is kind of cool is where we talk about putting a dummy variable in for seasonality. Well, it turns out that if epsilon is negative, so if there's a negative surprise in the returns, that usually leads to higher volatility the next period compared to a positive surprise in returns. So some people have explored what's known as an asymmetric Garch model, where it allows for a different, you do it almost the same way with a dummy variable, allow for a different volatility if your return was negative versus returns are positive. But this is like really important stuff for asset allocation. And I would like to thank you for actually agreeing to show up to the webcast. Thanks. Let's take 15-minute break. Okay, I want to talk about volatility a little bit more. I want to talk about correlation, covariance, and skew. No, I didn't want to embarrass Tim like too much, but his contribution to what we do in finance is really fundamental contribution. This model, while it's got shortcomings, is kind of like a standard practice model. Now, a question is, why are we using it in the class directly? And as he said, it is complicated to estimate. It's a nonlinear estimation. And I thought it would be best to just go through the intuition of it. We would have to give you separate software, which is available. As he said, in standard statistical packages like SAS or TSP, we do have Garch estimation. The most reliable way to do this is in kind of a matrix programming package like MATLAB or Gauss. And he's got these algorithms that are freely available. You can visit his website or email him, and he could send those to you. But you would need to install some extra software underneath. For us, I think it's most realistic to think about actually using this. And I've really wanted to press the intuition as to what volatility actually is. And what we actually came out with was, well, we don't really know. It's some expectation of variability. Okay, so when somebody says, well, the volatility is, they are overstating it, because we don't know what volatility is. Okay, we can have a proxy for volatility, but we don't actually know what volatility is. Volatility's got an expectation in it. Expectation of variability. And there's a lot of complicated questions, and I was pressing him on the horizon machine. So is it every 5 minutes, every hour, every day, every month? How do you do that? The theory for options pricing is all built in continuous time. That's like every tick in terms of what that Black-Scholes implied volatility is. So it really is pushing you towards the highest possible frequency edge. It's definitely not every month or every 2 months. So the key thing to realize here is that volatility is predictable, number one, it's persistent. And one simple way I think of framing this is that things raised to even powers are more predictable than odd powers. Let me explain what I mean by that. Take a return, raise it to the power of 1, you just get the return, right? You take a return and square it. Then one thing that happens is that you get rid of like all the negatives. Okay, and it turns out that that is somewhat more persistent than just the returns. And if we cube, then we get something kind of like skewness. And that's very difficult. Again, it's flipping sign and magnitude. Very difficult to forecast. With power of 4, is kurtosis. And that also is persistent. Persistent meaning predictable. Okay, so the basic model, let me actually go back to his model just to clarify a couple of things. Should flip back. Okay. Where he said, how do we get these longer horizon forecasts from the volatility model? Well, let's say that we've estimated our model using whatever statistics package, and we've got our model fit through the most recent time period. We've got a forecast of February 2001. Okay, how do we get the March 2001 forecast? Well, we've got in this model the January 2001 volatility. We've got the January 2001 squared residual from our forecasting model of the expected return. To get March, what we actually do is to take our forecast of February and dump it in right here. And what about the squared residual for February? From our forecasting model, do we have the residual for February? No, we have no data yet. So we can't really do anything there, and people might just put the overall average of the square in here. Okay? Let's not worry about this as much for the longer horizon, but the VT, we've got February's forecasted VT in here, multiplied by D1. And D1 is less than 1. And that's where he was talking about this kind of mean reversion. So if you think of doing this multiple times, because this is less than 1, we're going to approach the overall mean. If this D1 was greater than 1, as we forecasted out many periods, the VT is going to get larger and larger. Right? So we're putting a VT minus 1 in here, multiplying by something greater than 1, then VT is going to get large. Then I plug it in again to get VT plus 1, and the variance is going to explode. It's going to go to infinity if we go enough periods out. That's why he said it's very important to have this D1 being less than 1. So we get some mean reversion, and the longer horizon forecast will actually approach the sort of long-run, unconditional variances. So this model is highly operational, but you need the software to actually run it. It is statistical, the way that his original articles have framed it, in that there's no other information here. And one thing that I thought was interesting we pushed him on was to get information, let's say, from option prices into this model directly. So what you to take away from this, the basic structure, this is called a Garch 1-1 model. And that just simply means it's got the first lag of volatility in here and the first lag of the squared residual. Okay? A Garch 2-2 model would have 2 lags of the volatility and 2 lags of the squared residual. And it could be 2-1 or 1-2, whatever. There's many different formulations of this model. A very cool type of formulation, very useful for what we do. There was a question at the break from Lisa, who's one of the webcast students, and she was particularly interested in what sort of research Tim is doing now to kind of get a sense of where this volatility modeling is actually going. And I know where his research is because I see these papers all the time in the seminars and at conferences and off his website. And he's pursuing a number of initiatives, but perhaps most of his research is devoted to looking at this ultra-high frequency data that's recently available, and recently we've got computing speeds to actually deal with it. So volatility at the highest frequency, where we've got all the ticks for either futures trading or cash currency, and try to model that volatility. So that's perhaps the thing that where most of his research papers are headed right now. And we actually do, one of our sessions, we'll be talking about high frequency trading. I forget which one, I think it's number 10 or 11. We're doing high frequency. So we'll revisit that a little bit. Another issue is, what about the usefulness, and again, this was a question actually before the lecture, the usefulness of volatility for forecasting the returns. If we've been talking about forecasting returns, we've been talking about forecasting volatility. Well, is there a relationship between the two? And there is a class of models out there, the Garch-M models, where the mean actually comes into these models directly. So volatility can be a variable that affects the expected return. Indeed, in fixed income forecasting, we're often using measures of market volatility. And one popular measure is the VIX, which is the OEX, the S&P 100 option implied volatility. We've got a daily time series on that going back 82. So that's often put in there as an instrument to forecast returns. We began a list of variables that potentially could forecast returns in the last lecture. And volatility should be one of those variables. Okay, so that's something that you could at least look at. Okay. There was also a question of, it's really difficult to understand this idea of people talk about realized volatility. And what is that? So, and people talk about the difference between the expected volatility or the implied volatility and realized volatility. And throughout the first half, we're talking about volatility as an expectation of variability, something that you fundamentally cannot measure. So what is realized volatility? For example, for an option price, you've got a month of data, and the option is on some underlying asset. You've got returns every day. They take the standard deviation of those returns and call that the realized volatility. So what is that? Yes?
I'm just wondering, is it have the same name as historical volatility?
Yes, historical volatility. So people say, well, here's historical, or going back in time, the realized volatility. So what is that? Again, we're really struggling with the issue, what is volatility? So you think about it, I estimate a standard deviation within a month. And we know how to do that, just like I said at the beginning. We've got the returns, and we subtract the mean return within that month from each of those returns, square each day's difference between the return and the mean return over that month, and add it up and divide by the number of days, or take the average. How does that mesh with what we're doing? Because really what we want is the conditional volatility. Right? So we're looking at the conditional volatility. So we want something looking forward. Okay? And if you think about the realized volatility, you take the return, you subtract the overall average return within the month. That's not the expected return. That's just the average return. And then you just average that again after you square it. Take the deviation, square it, and then just average it again. So it is really an unconditional measure. There's no forecasting going on whatsoever. It's just the return. It is a measure of variability, assuming that you knew what the mean return was like for the month. So that's the realized return. And the question is, what is the link between that and the sort of conditional volatility? And they are different. The conditional volatility's got expectations of the returns in there. And it's got expectations of the square of the square of the deviation from the expectation. It's got expectations coming in there twice. It's conditional. And to be comparing conditional and unconditional is not that clear how useful that is. But here's some variability by that's realized. And that's kind of like a different question than what is the volatility, which is fundamentally expectational based. Now, there could be a scenario where somehow you could get into a Garch-style model, some sort of difference between what was realized and what was expected. That's a possibility, yes.
I don't know if I fully understand where you're going with, but is there a way to look at the difference between like a European and American style option, and if somebody exercises early, it's technically becomes realized, whereas the European option you can't exercise until expiration? Try to see what the volatility difference is.
And okay, so with the American option, there's this probability of an early exercise on dividend-paying sort of options, and then you can figure out the probability from that and how that affects the effective time to expiration, right?
I think.
Yeah. Well, I think it would be a lot easier just to look at options of different maturities. And then you can take a look at something that's known as the term structure of volatility. So with different expirations, you get different implied volatilities. And that might tell you something about the evolution of volatility through time. And that's different than that Garch kind of formulation, which is very mechanical, it's recursive. You just put the stuff in there and it forecasts out as many periods as you want. Okay? And eventually you get back to the overall unconditional mean volatility. But looking at these options, you can get actually a term structure of volatility. And indeed, a question I did not ask Tim was, is there information in the term structure of implied volatility that might be useful for longer horizon volatility forecasting? Indeed. We could calculate, it's kind of an interesting idea, with interest rates with different maturities, you calculate a forward rate. Right? So I got a 2-year government bond, I got a 1-year government bond, take a look at the yields to maturity, and I can figure out what the forward rate is, the forward rate between 1 and 2. And I can do an exercise where I actually take that information in the term structure that's observed today to see if that forward rate is a predictor of next period's interest rate, next year's interest rate. So I can do that, right? It's available to me. And it kind of makes sense that there's some information there, assuming no defaults, that the forward rate contains valuable information for forecasting future interest rates. And there's research that suggests that that's exactly the case. Some information is extracted from the term structure about future interest rates. Well, volatility, we can do the same thing. So we've got an option that's got 2 months to expiration, an option with 1 month to expiration. I can calculate the forward volatility rate. So the volatility that's implied by these 2 options for 1 month ahead. And potentially I can take a look at that to see how well it predicts that 1 month ahead. So stuff that you can do not just with the implied volatility that we were talking about in the first part, but you can take the whole term structure. Unfortunately, that term structure is pretty short because the liquid options, the most liquid options are very short maturity options. So it's not like the T-bond market where you could look at multiple horizons. But I think that's probably the way to extract the information that you're looking for on different maturities, rather than saying, well, the American option it's got effectively a shorter maturity, but that varies through time, and there could be disagreement. It's probably cleaner to use different maturities. Okay. Yes?
You mentioned earlier that there are models that you consider that there are good models to forecast the volatility on the returns. Excuse me, the returns based on the volatility.
Yes.
But then you are forecasting the volatility based on the returns and using
Yes.
the residuals. Is that not a problem?
Remember that what goes into the Garch model is the square of the residual. Okay, and some people are confused by that because you know that the average residual is 0 from your regression model. Like, you don't believe it, just pull it into your spreadsheet and take the average exactly 0. Okay. And it's also the case that the residual is not forecastable given the variables in your model. So again, pull your residuals off and try to forecast them with the lag values of the same variables in your regression, and you will get identically a 0 R-squared. Okay, because that's the whole idea. The residual is what's left over after you take all these variables into account. Okay. But what I'm asking you to do is to take that residual and square it. Once we square it, it's going to have a non-zero mean. And you can think about you get a 0 mean because you got some negatives and some positives, right? On average, it's 0. Well, once you square the residual, you get rid of all the negatives. So obviously, it's going to have a non-zero mean. But the other thing that's possible is that it's predictable based upon the same variables in your model. Because the regression model says that the residual cannot be predicted by the z variables in your model. It doesn't say that the squared residual isn't predictable. So a lot of what we're doing in assignment 3 is working on that squared residual to see if it's predictable. Okay? And the Garch model is very much related to that too. So the squared residual is going in there. It's getting some sort of coefficient. It's not the only thing in the model, but it's definitely there.
Yeah. My question was, so I forecast the returns
Yes.
maybe based on the volatility, and I
Yes.
get the residuals. Then I take these residuals, I square them, and I forecast the volatility.
Forecast them again, yeah.
You have to iterate also between
Well,
the two.
let's say we just have a simple model where we've got the returns are being forecasted by the slope of the term structure, one z variable. Okay, so then we estimate that model and we get residuals. Okay, we've got 31 years of residuals. And then we take those residuals and we square them. And then what I ask you to do in assignment number 3 is a simple arch model, not Garch. And all you do there is take the residuals squared and regress them on the lagged squared residuals and see how far you get with that. It's a simple model of heteroscedasticity. Okay? What we could also do would be to take those residuals, square them, and construct a Garch-like model. And I'm not requiring you to do that. Indeed, 1 year I actually did require in Excel the estimation of the Garch model. And it turned out to be a computational nightmare that you don't want to relive. Okay? Even with faster computers, it was taking like many iterations to get those parameters. So just basically take my word that you can do this fairly simply in a package that's optimized to do this. Indeed, even for asset allocation, we use Excel only because it's convenient to do the optimization using Solver. Like when you're in the field, you're not going to be using Solver. Okay? You'd be using some other optimizer like Northfield, and it's like their business to design a program that works efficiently. And we don't have to worry about constraints not being consistent, nice interface. Use software that's dedicated to actually doing this stuff. But for Excel, it's very useful in that we can get the intuition, we can see how it's pivoting and stuff like that. But there is software to do this. The key thing for you is to understand the basic idea. It's a recursive formula. We're using squared residuals. And I think we'll get that out of assignment number 3 and what we heard today. Okay? Yes?
It sounds to me as if the purpose of squaring the residuals is only to get rid of the negative sign so that you have some predictive value. Has anyone looked at the alternative of using absolute value of epsilon as well?
Yes, and Tim actually mentioned that when you square stuff, if you've got like a really big observation, like in daily returns, October 1987, it's a really big observation. Square, it blows everything away. So your models just fit to one observation. Okay, so an alternative is to use a so-called more robust technique, and that would be to look at the absolute value of the residual. And again, the mean of the absolute value is not 0, right? It's the same idea. The difference is these big values just don't dominate as outliers. Okay, I'm not sure I should use the word outlier, because I don't consider October 1987 an outlier. It just is something that happened. So yeah, indeed, in regression also, you know how regression works, where we're trying to minimize the squared residuals. You fit the parameters to get the smallest possible squared residual, or the average of the squared residual. That's the theory of regression. That's how it works. Well, there's another type of regression where you do, instead of least squares, that's where least squares comes from, you do least absolute value. So you optimize the parameters to fit the average absolute residual. And that's called robust regression. And again, that's something that we don't do. I don't even think it's available in stat graphics, but people that are concerned about influential observations might go to a method like that. Okay? So where are we in terms of this volatility modeling? As I said earlier, it's important that we know how to do this, but it is on purpose that most of your time in assignment number 3 is devoted to getting the returns. So in terms of kind of like simulations of asset allocation strategies, you can actually measure like how important it is to get the mean right, or the volatility, or the correlations. And the mean is like an order of magnitude more important to get that right. Okay, whatever getting it right actually means. Okay? For us in our simulation, it just simply means a higher level of performance. Okay? We need to worry about volatility, and we need to worry about covariance also. So let me show you how to get the covariance, and then what I need to talk about is somewhat of a compromise if we don't have the Garch and Arch machinery actually working. Okay, so let's go to the overhead. So we've got our expected return. And that model is RT equals, did I use B? And let's just assume just one thing that we're using for prediction. Always lagged. Okay? So that's our expected return. Always with the lag Z, right? And we talked about last time the importance if we're using macroeconomic data, we might have to use 2 lags. Indeed, I don't want to see any assignment number 3s with, the first lag of the CPI, when I know that's not available at the end of the month. Okay? It's got to be at least 2 lags. Is there any variable in the prediction model that we would put in here with a time t?
Could be some sort of futures, price of some kind.
That's observed at t-1. Is that what you're saying? So we're at the end of January, right?
Or, the end of the month, end of February. February.
So it could be some expectational sort of price that, but it is available at T-1, right? So it might represent something in the future. Okay. A really good example of this is the 30 a Treasury bill that's got 30 days to maturity. Okay, it's observed at January 31st. Okay, and actually know what the return is going to be in February. Everybody see that? The Treasury bill is a discount instrument. We know at the end of February it's going to have a price of 100 with little chance of default. So therefore, I actually know what the return is in February. And that's kind of an exception. So it is expectational in a way, but it's an odd expectation in that the expectation exactly equals what's realized. So for the 30-day Treasury bill, there's no uncertainty in what the return is going to be for the next month. Okay? So that's the only exception I can think of. So this is simply a regression model. This is the residual. As I said, the average residual is 0. The residual has 0 correlation with the z's. The squared residual is something that we can actually work with, and we can think of estimating a model. Simple model where we take the epsilon. So this could be a simple arch kind of model. Epsilon t equals, I'm running out of, let's go to alpha maybe. Alpha 0 plus alpha 1 epsilon t minus 1 plus some other Greek letter. And what is the R squared in this regression? Exactly 0. And the alpha 1 is exactly 0. Okay, alpha 0 is 0. What we can do is square these to give it some content. So we're taking the squared residual and regressing on the lag squared residual. Okay. And this is a simple model of conditional volatility. Now we've been through the Garch model and how that changes it, but let's think about this just for a minute. What happens if I run this model and it turns out that the R squared is 0? So the alpha 1 is insignificantly different from 0. It's not exactly 0, but it's just not significantly estimated. So I got a t ratio of less than 1. What are my forecasted values for epsilon squared t going to look like? Suppose this is 0. What are the forecasted values going to look like? It's going to be alpha 0, right? Okay, so effectively, what we get here is the expectation, which is the same as the forecast, of this thing squared is just going to equal alpha 0 if no predictability. If no arch. This is like what's known as the mean squared error in a regression. Okay. Now, I don't mean to complicate things too much, but I want to relate this thing to the unconditional volatility. Okay, so the unconditional volatility remember, I just take the returns, right, minus the, and let's just call the mean return I guess we can call it E of RT, which is just a constant, right? Just a sample average. Take this, square it, and then take the average again. Again, that's what you get when you press the variance button in whatever statistics package or Excel. Okay. Now, we estimate our arch model, and we don't get any predictability. So we just get that alpha 0. So what we've got here is the expectation of epsilon squared Do you see what the difference is between these two? Okay. Right here, we've got the returns minus the overall mean return. Right here, we've got the return minus the predicted return. Right? It's the residual from our regression model. So if we want to call it predicted return, we're squaring that and taking the average. So there's two levels of stuff going on here. The unconditional is simply subtract the average, square it, and take the average. That's unconditional. So it's average and average. Two averages going on. For this model, even if there's no detectable forecasting of the variance, we forecast the return, and then we average the squared residuals. So this is average returns here, and then average of the squared deviations. Here we forecast the returns, and then average the squared residuals. Okay? And let's call this unconditional / conditional. And if we've got predictability in the variances, then we can have conditional, where we predict the epsilon t squared. That means we're forecasting returns, and we are forecasting the squared residuals. Okay, so to me, the last thing that you want to do in asset allocation is this. That didn't turn out too well. I've got at least one of the color here. You don't want to do this. It uses no information whatsoever. If you don't have all the machinery available to do volatility forecasting, you don't want to use the unconditional. What you can do is this compromise, where instead of putting the variance equal to the variance of the returns, you put the variance is equal to the variance of the residuals from your forecasting model. Okay, and those are going to be different. Okay. Actually, there is a situation where they are the same. What's the situation where they're the same? Yeah, if your prediction model is no good, right? If it's got a 0R squared, then these are identical. But if you've got some ability to predict returns, then what we can do is take basically the variance, the usual variance of the residuals. And this is somewhat of a compromise. If we've got the full machinery, then we actually operate on the predicted squared residuals. And that's what the Garch model is doing, the Arch model, and many different other types of models. Indeed, you could think in your model in assignment number 3, you've got your squared residuals because you've got your forecasting model for the means. You could regress on the lag squared residual. You could put in the lagged implied volatility for the underlying asset. So you could do that. You put in the seasonality that you think is relevant. You could put, Tim mentioned trading volume. Very useful. You know, and a lot of this kind of begs the question that was asked after the lecture on Thursday. You know, what is the economic intuition of what's happening here? Like, why fundamentally do these variables predict returns? Well, good question for volatility too. Now you had to think about that first question for the returns for assignment number 3. But you don't really need to think about the question for volatility. So why is it that some variables would forecast volatility? So Tim said trading volume is, a number of people have found that to be quite useful. So why would trading volume be related to volatility? You got to think about, you know, what this really means. Some measure of variability that's expected. I think that's the closest that we got to was a definition of volatility. And the definition is not complete because we don't know what the frequency is. We kind of debated the frequency a little bit. So why would trading volume be related fundamentally to volatility? And you know, I've thought about this a little bit, and there are these economic models out there. And one model that's real powerful says that if everybody agrees, then there's no trading. Or the only trading that takes place is purely for liquidity. If we all agree on the price, then why would we trade? It's at the right price. You're not going to buy or sell for information reasons, at least. So with agreement, there's no trading. With disagreement, there's trading. Okay, so the more disagreement, the more trading. The more trading, you see it in trading volume. And disagreement, to me, is one of these fundamental things that should influence volatility. Indeed, it gets to the reason for volatility. Is that some people disagree as to what the value actually is for the underlying asset. So this is, you know, one reason that trading volume could be a useful instrument for volatility, and not the only one. Another one that I've considered using in my research, we've got organizations like IBIS and Zacks, First Call, making forecasts of earnings. Okay, so these are the expectations of earnings for different analysts. One thing that IBIS includes that I've always thought is a very useful measure, potentially, is the standard deviation of the earnings forecasts. So amongst the 20 analysts, what is the standard deviation of their forecasts? Well, to me, that's a perfect measure of disagreement. We know that standard deviation is going to be very small if they are all very tight in their forecast, and it's going to be large if they're all over the map. Well, to me, again, this is a measure of disagreement that could be linked to volatility. Volatility is likely to be positively related to fundamental measures of disagreement. So again, there's a variable that is a candidate variable that seems to be founded in the sort of economics that could forecast volatility. So one of the critiques, and Tim certainly knew when he was talking, he's fully aware of the critique of the Garch kind of modeling, is that it's purely a statistical framework. Volatility is a function of the lag volatility. And it would be like me spending 12 lectures on technical analysis, where the returns are going to be a function of some pattern in the past returns, and that's it. Okay. And I think that people doing volatility modeling, like Tim, have realized that, well, that's a potential weakness of that approach. It's a powerful approach, and it gets you a long way. But there could be other stuff that's important for volatility. There is other information that's relevant for volatility, other than the lag. Okay? And he and other people have kind of laid the foundational work. And his response today was, yeah, that's true. And this model can accommodate it. Just like if we had a forecasting model for our returns, and it had just one variable, the lag return, you could accommodate other variables. Now, it turns out it's a lot easier to do this for your forecasting models, because we run these simple models in Excel or stack graphics. For his models, more complicated. But the principle's the same. We can put other information into these models and get some sort of forecast of volatility. Okay, so there's like 3 levels of things that we can do with volatility. We can put the unconditional in, and when you put the unconditional volatility in there, okay, it means that you are taking a stand. You are saying, I can't forecast the returns, and I can't forecast the volatility. And that's it. Then you could do this combination unconditional conditional. You forecast the returns, you pick off the residuals, and you put the unconditional variance of the residuals in there. Okay, so that's saying, well, I can forecast the returns, but I really can't forecast the variance. And the third level is I can forecast the returns and I can forecast the variance. That's where you use the full Garch kind of like model or alternative model. Okay. Now, a couple more things that we need to do. Covariance is one. Okay. Let me write the definition of covariance. And covariance is what we actually use in our asset allocation. We actually, correlation is just an indirect measure. So what about covariance? In covariance, let's look at 2 assets, asset 1 and asset 2. So the covariance is simply the expectation of R1T minus the expectation of R1T times R2T minus the expectation of R2T. And this whole thing, you take the average out. Okay, and again, I want to force you to think about this in a spreadsheet. So we've got in column 1, we've got the return for asset 1. In column 2, we've got just the overall average. It's the same thing in every single row. And then we take the difference and dump it into column 3. So let's call this column 1, column 2, and the difference is column 3. And then in column 4, we've got our second asset return. And in column 5, we've got the mean of that return over, it's, again, the same number in every single row. Then we take the difference, and that's column 6. Then we just multiply columns 3 and 6 and take the average. And that's the covariance. Okay. And if you hit the button covariance in Excel, it's going to deliver the same number. Okay. Now, you know what we're going to do already, because it's identical, it's symmetric to variance. All we're going to do is, instead of using the overall mean right here, we're going to use our forecast of asset 1. And what is the difference between the actual return and the forecast? What do we call that? Residual. So really, when we use the residual, we've got epsilon 1t. And over here for asset 2, it's the same thing. It's just epsilon 2t. So for this unconditional / conditional, all we're going to do is multiply the residuals together from the two assets and take the average. Okay, so this is the unconditional / conditional. Residuals from your two models for asset 1, asset 2, multiply them together, take the average, and there's a different measure of covariance that takes into account that you've got some predictability. Okay, that's easy. Now, what about the full conditional? We've got epsilon 1t, conditional, conditional. And we've got epsilon 2t. What are we going to do to make a full conditional model here? What do we need to do? We need to forecast that thing. Just like we needed to forecast the square of epsilon 1t for the volatility. So we need to forecast that. And the way to do it, you think of a simple model where we've got epsilon 1t, epsilon 2t equals G0 plus G1 times the lag. And it's just an autoregressive model of covariance. And we could have the equivalent of the Garch model for this also. And I'm not going to write it down, but you can probably guess what it looks like. We create a covariance and recursively and estimate it like this. So this is the most difficult way to proceed. The unconditional conditional is immediate. You can get that immediately from your work in assignment number 3. And we can kind of go on from there. We only have a couple of minutes left, but I just wanted to mention 2 things that are important. I showed you already that these correlations and covariances are very dependent upon the stage of the business cycle. So how could we allow for that in a model like this? Instead of simply saying that the covariance next period is just a function of what it was, the product of the residuals the previous period. How could we get 2 different kind of business cycle effects in there? We could have like dummy variables, indicators of the business cycle. We could have this thing be different if it is a recession or expansion. There's many different ways to actually get this into the model. Okay. And the final thing that I wanted to mention and kind of where we're going to start on Thursday. I want to start thinking beyond just mean and variance and push you towards skewness. Okay? I'm going to show you the mean variance skewness frontier and how to operate within that paradigm. If you're just kind of like guessing here as to how we might want to forecast skewness, we know that the volatility is epsilon squared that we're forecasting. What would you do for skewness? It's a cube. All it is the epsilon cubed. So I want to talk about the possibility of forecasting skew and how that relates to what we mentioned with Tim in terms of this asymmetric volatility. So asymmetric volatility simply means if return is negative, volatility is higher. I want to show you the relationship between that and skewness. And I want to show you how to modify the asset allocation framework to take this stuff into account. So this lecture, it's got a lot of material in it. You know, it's a lot of like equations and things like that. You got to do assignment number 3. And you're going to see how to actually do this stuff. Okay? And even if we don't have the full machinery of the Garch model, you can still go a long way with just using your residuals from your forecasting model. Taking the product and the average, that is way better than saying, I can't predict anything. Okay, so we'll see you on Thursday.